Let's stick with the election. Our next guest expecting markets to whipsaw no matter who wins. So joining us for more, we've got Ken Mahoney, Mahoney Asset Management's CEO. Ken, it's great to speak with you. I want to point out something you say at the top of your notes to us. Institutions looking to take advantage of the whipsaw and let retail make rash decisions. So we're not going to allow that here at Yahoo Finance. Talk to us about
the buck's going to stop right here. It's
That's exactly right. So what's your advice to the retail investors listening?
Yeah, don't get involved in this. There's a lot of emotion, and I know it's easy for me to say that, but the last thing you want to do is get whipsawed out of your position, and also use an emotion, meaning, you're looking for one candidate to win and they lose, and you say, I'm going to sell everything. Before this all started, our founding fathers kind of figured this out, that we have a balance of power. And after this election, we're still going to have a balance of power. And I have to tell you, there's so many tailwinds. I could take up my entire program here and tell you all the tailwinds we have, including the Federal Reserve probably going to cut rates again tomorrow. You have this huge spend in tech and so forth. It's just, it goes one thing after another. We've had good earnings. You have performance anxiety. You have a lot of bears been on the sidelines. They're going to have to commit capital towards the end of the year. Otherwise, the index is going to be way ahead of them. So again, I just say that, sometimes we lose sight. We have to come back 30,000 feet to kind of see where we are. And there's a really strong tailwind despite who wins.
So then, Ken, what should investors be doing? How can they then take advantage of some of these tailwinds?
Right. So our favorites are still the market leaders: NVIDIA, Apple, Microsoft, Amazon, Donner and Blitz, and those names. We've been putting bids like 5 to 7% below the market where they're trading at now. We may never get filled, but we can get some whooshing around. The market's really, again, it goes back and forth. Some days I think they want Trump to win. Other days I think they want Harris to win. But at the end of the day, I think they want someone to win in the next 24 hours or 48 hours. I don't think the market's going to like several weeks of going ballot counting and back to attorneys and judges and courts. Market's not going to like that. So if it's decisive in the next couple of days, I think the market just continues. But that's the way we'd be playing this right now, is some of your best stocks you like with the added volatility, make volatility your friend, not your foe. And by doing that is actually, try to buy some stock, your favorite stocks below the market, which is trading right now.
It's interesting. Mike Wilson called it a clearing event, and he was specifically talking about a clearing event in terms of just the volatility, kind of moving past this election obstacle, and then we can focus on that AI rally to get us to 6,100 by year end. What could a clearing event look like, though? And is the market going to be ready to kind of move on just as soon as we get an election result?
I think so. I think most investors know this is, come on, stock market's near all-time highs. That's a leading economic indicator. Job market's strong, check that. Inflation's a tad too high. Corporate earnings are pretty good, but in the corporate earnings calls, you kept on hearing AI and data center spend and more corporate spend. We're in a revolution here. We haven't seen anything like this since the mid-1990s when we all went out and bought PCs. That was consumers. But B2B, we haven't seen anything like this. So I think, look, this is definitely a degree of uncertainty. It has been something that we've been dealing with from about the beginning of the year, talking about this very date. But Mike Wilson's right. Once you get past this, I think the fundamentals are very strong for the market. And 6,100 target, who knows? I mean, it could be higher, it could be lower. But the point is, directionally, it feels like between now and the end of the year, the market can go higher.
What about the valuation concerns, though, Ken? Why isn't that something that you're maybe a bit more worried about?
So it has a lot to do with interest rates. When you have rates much, much higher, that definitely sucks out valuations of companies, and you start doing that kind of, present value, future value correlations. Again, not to say it is. Some of these companies are very rich, but a lot of the companies we look at, it's not the PE, which is rear view mirror, the price earnings. We're using forward PEs. And you look at forward PEs, especially market leaders, historically, they're right around where they are on average. So if you use forward PEs, I think you kind of give it a little break, that it's not so overvalued. And if rates are declining, that's going to offer less competition to stocks. And that's why, you can afford some of these higher valuations with lower interest rates. Again, higher rates, I would say lower valuations. In general, lower rates, not just Fed fund rates, but hopefully the 10-year starts coming down a bit, favors stock investors, even if it feels like it's a little bit rich.
All right, Ken Mahoney, thanks so much for taking the time to join us here this morning.